My name is Steven Flynn. I'm a partner with Andersen Tax in our Vancouver office. And today I'm going to talk about U.S. federal income tax and its impact on Canadian businesses that expand to the U.S. We'll talk about the different U.S. federal income tax rates that apply to business activity in the United States. We'll talk about whether or not to use a U.S. corporation to conduct that activity. We'll also talk about whether to file a U.S. federal income tax return even when there's no U.S. federal tax due. So in December 2017, the U.S. passed sweeping tax legislation changes. And one of the biggest changes that occurred was the U.S. federal corporate income tax rate, which before the changes was at an average rate of about 35%. But starting in 2018, that rate dropped to a flat rate of 21%. And its impact on Canadian corporations that invest in the U.S. market was significant. It made the choice to use a U.S. corporation much easier than it ever was in the past. So for example, when a Canadian corporation expands to the United States and forms a U.S. corporation, they can pay a flat rate of 21% on the income. When they take the profits after tax and bring that back to Canada, they'll pay a withholding tax rate, if they control the corporation, of 5%. And so the combined total rate is approximately 25 or 26%. Well, in comparison, if the same Canadian business continued to operate in Canada, its tax rate could be anywhere from 12 to 13% if they're subject to the small business tax rate in Canada, or as high as 27 to 30% if they're not subject to small business tax rates. So that combined U.S. federal income tax rate plus the dividend withholding tax rate is somewhat similar to the Canadian tax rates that are already occurring. Canadian corporate tax rates have actually been less than the U.S. federal corporate tax rates. For example, in Canada, corporate tax rates range anywhere from 26 to about 31%, depending on the province that you're operating in. In contrast, in years prior, the U.S. federal income tax rate for a corporation was approximately 35%, and then add on top of that state income taxes, which can range anywhere from 0 in certain states to up to 10% in other states. That combined U.S. federal and state income tax rate of, let's say, 40% was much higher than the Canadian combined federal and provincial corporate income tax rates. And as a result, you saw a lot of businesses that would set up in Canada, would operate in Canada, and would try to avoid being subject to U.S. federal income tax. Starting in December 2017, the U.S. passed sweeping tax legislation changes, and as a result, the U.S. federal corporate income tax rate fell from 35% all the way to a flat rate of 21%. And so if you take the 21% rate, add in your state tax rate equivalent, now your U.S. federal and state income tax rate is very similar to the Canadian corporate income tax rate. And as a result, Canadian businesses have much more flexibility and freedom when they operate and expand in the United States because they're not so concerned about trying to avoid paying U.S. federal income tax. Well, the way to view U.S. federal income tax is not necessarily to avoid paying it, but to ensure that it's effectively claimed as a foreign tax credit or some sort of deduction against Canadian income taxes. For example, a Canadian corporation that forms a U.S. corporation as its subsidiary, that U.S. subsidiary can operate a U.S. trade or business. It can be subject to that 21% U.S. federal income tax rate. It'll be taxed again on the profits that get brought from the U.S. to Canada as a dividend, subject to a withholding tax rate of 5%. But when the profits come back to Canada, depending on the type of business, those profits can be either exempt from Canadian income tax, or Canada will give effectively a foreign tax credit for that U.S. federal tax liability. So as a result, if the corporation's Canadian corporate tax liability is in that 26 to 30% range, you're effectively getting a full credit for the U.S. federal tax payable, and you're indifferent between operating in Canada versus operating in the U.S. So any effort or costs or complexity expanded to try and reduce or eliminate U.S. federal tax really doesn't add any value. However, there's other situations where a Canadian corporation either might have losses and they're not paying current Canadian tax, or perhaps they're subject to the small business tax rate of 12 to 14%, that the Canadian corporation may want to try and reduce or eliminate U.S. federal income tax. And there are strategies and methods to do so. So we talked about ways to reduce federal income tax, and in our next segment, we'll talk about situations where one can actually eliminate U.S. federal income tax. So if there's a need to avoid paying U.S. federal tax, There's a number of different ways to do it. For example, the Canadian corporation can take expenses it has that directly relate to that U.S. business and charge them through as a cost recovery. Alternatively, the Canadian corporation can charge for its assets that are used by the U.S. business. For example, if the management team and the employees of the Canadian corporation are rendering services to the U.S. corporation, anything from accounting and financial support to management or executive support, the Canadian corporation can charge a fee for its time and its expenses to the U.S. corporation to provide expenses to the U.S. corporation to lower its income, to lower its federal income tax. Alternatively, the Canadian corporation might charge a royalty for any intellectual property it has that the U.S. corporation is using. It may also charge interest on any loans that the Canadian corporation has made to the U.S. subsidiary. One has to take into account both the withholding tax obligations, any kind of reporting requirements when considering payments such as royalty payments and interest payments. Another consideration are the transfer pricing requirements that the U.S. and Canada have with respect to related party transactions. For example, a Canadian corporation that owns a U.S. corporation is subject to the transfer pricing rules in both Canada and the United States, which in general terms require fees and prices and charges to be conducted at arm's length prices and at fair market values. In this situation, a U.S. corporation owned by a Canadian corporation would be considered a related party and subject to the transfer pricing requirements. So we talked a bit about reduction or savings of U.S. federal income tax in certain situations, but there are other situations where we can completely eliminate the U.S. federal income tax liability. And it's under the provisions of the Canada-U.S. Income Tax Treaty that we look to determine whether a Canadian business has what's called a permanent establishment in the United States. Now, a permanent establishment can be anything from a fixed location, an office, a warehouse, a construction project that goes on long term. It can also be employees that are working in the United States that can execute contracts on behalf of the business. There are other situations where when Canadian employees spend a certain length of time in the United States, that can create what's called a services permanent establishment. If a permanent establishment is established in the United States, then the Canadian business is subject to federal income tax. However, where there's no permanent establishment, under the Canada-U.S. Income Tax Treaty, the Canadian business is actually not subject to U.S. federal income tax. And you see these situations where consultants will do their work from Canada but perhaps travel infrequently in the United States. You'll see these situations where Canadians businesses sell products to the United States but have infrequent travel or really don't have a presence or a physical location in the United States. And so as a result, there wouldn't be any U.S. federal income tax levied on the Canadian corporation, and it can make the Canadian corporation's expansion to the U.S. quite simple and straightforward. However, that Canadian corporation still has a requirement to file a U.S. federal income tax return. And it's required to do so for a couple different reasons. One, under provisions under U.S. federal income tax law, a Canadian corporation is required to file an annual U.S. tax return to disclose any reliance on a U.S. tax treaty that it has with another country to avoid or eliminate U.S. federal income tax. And the failure to do so can result in an annual penalty of up to $10,000 per year. As well, for a Canadian business that is starting to expand in the United States, it may have a permanent establishment, it may be avoiding a permanent establishment at the start. However, it may become, as it grows and expands, have a permanent establishment later on. And so the act of filing U.S. tax returns on an annual basis will start the statute of limitations and only give the IRS a finite period to audit, review, or investigate and challenge whether that Canadian business is actually subject to income tax or not. If a Canadian business never files a U.S. tax return, that statute of limitation never starts, and the IRS in theory could go back decades to try and assess U.S. tax. Finally, the importance of filing a U.S. tax return for that Canadian business relying on the treaty is that if the IRS reached a different conclusion and that it should be subject to U.S. tax, at least the Canadian business can deduct expenses against the income it's earning from the U.S. So for those reasons, it's important for businesses, for Canadian businesses to file U.S. tax returns even though they're not subject to U.S. federal income tax. Well, while the U.S. federal income tax has been eliminated, the Canada-U.S. Income Tax Treaty doesn't cover state income taxes, and so state income tax may apply even where U.S. federal tax doesn't. Well, it's important to understand the effect on Canadian businesses that U.S. federal income tax has. Everything from the choice of entity to use, to the rates and prices charged to the U.S. business, and the likelihood that the Canadian business has to file a U.S. federal income tax return.